Investors and other stakeholders also expect transparency and ethical conduct, making ESG an essential aspect of building trust. Ultimately, effective ESG practices manage not only a company's reputation, but also its relationship with the broader ecosystem that it operates within. The global impact of ESG. As we said before, ESG is not limited to companies and not just communities either, and it has a significant effect on global outreach. By prioritizing environmental sustainability, ESG practices align with global objectives such as mitigating climate change and conserving biodiversity. On the social front, ESG initiatives address pressing challenges like poverty and inequality, contributing to a broader global development. The collaborative nature of ESG becomes evident through partnerships between companies, governments, and organizations across borders, all working together to address shared challenges. ESG encourages companies to innovate sustainably, develop solutions that can drive positive impacts on a global scale, and innovate more. So, as a financial investor, how do you assess a business's ESG? Now that we've established that ESG is important, how do we go about measuring it? Assessing a company's ESG performance involves evaluating its practices across environmental, social, and governance dimensions. ESG rating agencies play a pivotal role, providing scores based on established criteria that measure companies' alignment with ESG practices. In some sectors, specific ESG standards are in place, setting expectations for how companies should operate sustainably. As you can see on screen, there's something called the MSCI ESG rating, which is one of the ESG rating agencies. Additionally, transparency is key, as companies share their ESG data through reports disclosing their efforts and impacts. A critical aspect is materiality, which means focusing on the ESG factors most relevant to a company and its industry. This ensures that efforts are targeted where they matter most. ESG assessments serve as a dynamic tool for companies, not just to measure their current performance, but to identify areas for growth and enhancement. So, how can businesses incorporate ESG? Incorporating ESG into business operations requires a nuanced and comprehensive approach. It starts with strong leadership commitment, with top management actively championing ESG principles. It can't just be an afterthought. It needs to be integrated into the core business strategy, along with the business principles and the business plan, which we discussed earlier. Stakeholder engagement is critical. Involving employees, customers, and partners ensures that ESG initiatives align with their needs and concerns. To measure progress, establish clear ESG metrics and targets, or maybe consult ESG agencies. This helps hold companies accountable for their efforts. Additionally, awareness is key, so employees understand the significance of ESG and their role in its implementation. Innovation thrives when ESG goals are aligned, so companies should encourage research and development that supports sustainability. So, ESG versus non-ESG stocks. Although we've clearly established that ESG does have benefits, how does it really help in reality? Theory isn't always right. So let's look at in reality. The choice between ESG and non-ESG stocks has had significant implications for investors. ESG-aligned companies tend to demonstrate better risk management and resilience against market turbulence, as we mentioned earlier. Research indicates that over the long term, ESG stocks can potentially outperform their non-ESG counterparts, driven by sustainable practices and responsible strategies. Moreover, as the demand for ethical and sustainable investments grow, especially in the modern world, ESG stocks could experience increased investor interest. ESG-aligned companies may also face fewer regulatory hurdles and reputational risks, making them more potentially stable choices. For example, they may not be affected by laws governing carbon taxes, and they may not have fit quotas which most companies that are not ESG focused may fail to meet. Beyond just financial gains, investing in ESG stocks also aligns with broader trends in responsible investing and sustainable consumer behavior. So, let's look at a mock situation and compare two companies, one which follows ESG practices and one that doesn't. A company that produces renewable energy has a strong track record of reducing carbon emissions and promoting clear energy. As a result, they've experienced steady growth driven by an increased demand for renewable energy sources and favorable regulatory policies which may reduce tax or provide subsidies. Additionally, they'll experience positive media, which can also help boost the company. On the other hand, a company which relies on fossil fuels will experience criticism for their environmental impact and negative media due to their contributions to climate change. As a result, their stock is likely to be volatile due to fluctuating oil prices in a dynamic market, changing that market dynamics, and growing concerns about environmental sustainability. As a result, in this situation, it's clear that the prior case is better when they use renewable energy. Additionally, let's look at a second example, but this time focusing on the social and governance aspects. In a diverse workplace, a company that promotes a gender and ethnic diversity and a workforce that represents a wide range of backgrounds is more likely to succeed than one that doesn't have these same practices. This is because employees are likely to be more motivated in the workplace, and media is likely to show companies that focus on diversity in a positive light, whereas companies that don't focus are likely to face criticism. However, this is a nuanced approach. We need to look at reality, and in some cases, companies that don't have ESG principles in the moment may outperform those which do. However, in the long run, it's important to note that as the world becomes increasingly focused on social objectives, ESG will grow in importance. And as a result, non-ESG companies that may be in a better position now may not be in that same position in the future. So in this section, we'll just go over how to construct a portfolio and diversification and the types of management and the basics of how you construct a portfolio. So first of all, what is diversification? Diversification is essentially the process of purchasing assets from a different from different asset classes to expand the number and type of securities in your portfolio. So if we look at this diagram, we can see here that on the x-axis, there's number of securities, and on the y-axis, there's the standard deviation of your portfolio's return. The height represents the total risk, and as you can see, as the number of securities in your portfolio increases, the amount of unsystematic risk decreases, whereas systematic risk persists, and we'll get to that in a bit. Essentially, by purchasing more securities, you're going with the concept of not putting all your eggs in one basket. And since you're spreading your risk over the portfolio by choosing companies in different sectors and industries, you're able to avoid your portfolio crashing if one of these things fails. Empirical evidence suggests that all it takes is about 30 to 40 different securities to achieve a fully diversified portfolio. Okay, so what are the types of risk? Well, there's systematic and unsystematic risk. Systematic risk is a market risk, which is non-diversible, which means you can't get rid of it if you diversify, and it stems from market-wide risks. Unsystematic risks, on the other hand, are company or industry-specific risks that are inherent to a specific investment. Systematic risks are non-diversifiable, which means they cannot be get rid of. This is a risk that remains after efforts have been taken to diversify a portfolio. Systematic risk incorporates things like interest rate changes, inflation, recessions, and wars, among other major changes. Shifts in these things can affect the entire market and cannot be mitigated by changing positions within a portfolio of equities, because it affects every single equity. For example, the global financial crisis is a great example of systematic risk. Anyone who invested in the market in 2008 saw the values of their investment change drastically from this economic event. The Great Recession affected asset classes in different ways, as riskier securities, typically those that were leveraged more, were sold off in large quantities, whereas simpler assets like treasury bonds became more valuable. Unsystematic risk is a company or industry-specific risk that is inherent with each investment. And unsystematic risk can be reduced by diversifying, as we've seen in this diagram. Systematic risks include things like inflation risk, interest rate risk, exchange rate risk, and things like pandemics and war. Unsystematic risks are things like business risk, financial risk, default risk, and liquidity risk, which are specific to certain companies. So how do you measure your portfolio's performance? Well, the best way to do so is using benchmarks. A benchmark is a standard tool or measure that you can use to analyze the risk of a given portfolio. Individual funds and investment portfolios will typically have an established benchmark that you can already use for standard analysis to check your level of risk. Okay, time-weighted versus dollar-weighted returns. Time-weighted returns are determined without regard to any subsequent cash flows from the investor. It measures the performance of the investment over a certain period of time, not the returns of the investor. Returns quoted by mutual funds and other investment managers are time-weighted because the portfolio manager doesn't have any control over future cash flows of investor dollars. In contrast, a dollar-weighted return considers subsequent contributions to and withdrawals from an investment. For example, it considers timings and sales of purchases. A dollar-weighted approach focuses on the returns of the investor over a period of time, and this will usually differ from the time-weighted return. So how do you measure portfolio risk? Well, to measure risk, we need to identify what risk is. As we mentioned earlier, risk is the chance that a stock might fail, or the risk of volatility. So to measure risk, we would measure the chance that the performance of your portfolio as a whole would differ from the returns of the market or the benchmark portfolio. And the best way to calculate risk is using a standard deviation, which gives you returns over a given period. Standard deviation is the measure of dispersion of a set of data from its mean. It measures the absolute variability of a distribution. In essence, the greater the standard deviation, the greater the deviation from the mean. And this is the formula to calculate standard deviation. If any of you have taken statistics before, you'd be able to understand it. But if not, it's not necessary that you understand how to calculate standard deviation to actually employ it. You can use any online calculator to actually figure it out. So here is a standard deviation bell curve. Essentially, the areas within the curve are the higher likely opportunities. So in this general area, 68.27% of opportunities will follow this. But as we go to the extremes, more and more situations will fall under the blanket. However, the rate at which it does so is diminishing. So active versus passive management. Passive investment strategies seek to replicate the constituents, weights, and therefore the risk and returns of a specific benchmark of index securities. It's a buy and hold strategy that does not seek to pick winners and losers among the securities, but rather just hold them and see how things play out. The benefits of passive management include low fees, enhanced tax efficiency that stems from low portfolio turnover, and a limited portfolio management infrastructure, essentially meaning it's easier to manage yourself. The most popular vehicles for passive investment include index mutual funds and ETFs, or exchange-traded funds. Active management, on the other hand, is based on the belief that risk-adjusted returns above the benchmark can be achieved through security selection, market timing, and sector rotations by highly skilled professional portfolio managers. Essentially meaning you pick and choose stocks based on how you think they're going to do. Actively managed portfolios generally result in significant portfolio turnover as the manager reacts to market and temporary trends, either observed or forecasted. This high turnover, combined with the costs to staff a portfolio and management team, requires the manager to charge significantly higher fees than they would charge for a passively managed portfolio, and generally results in poor tax efficiency, as frequent buying and selling of securities may result in something called a capital gains tax, which is essentially the tax you pay when you sell stocks. This capital gains tax is greater when you sell a stock within a period of less than a year, and it's less when you sell a stock that you've held for greater than a year.